Ladies and gentlemen, welcome back to another very exciting day on Wall Street where you had one of the most historic rallies. This is going to be a day where you look back at and you're going to say, wow, that was really a face ripper rally. And everything, virtually everything, played along in this rally. AMC Stock is no exception there. It was up 18% on the day, a very strong day overall, and a lot more is likely to be coming our way. We're going to talk about the situation with hedge funds. The Satori Fund just came out and said that a lot of hedge funds this year are down over 50%. And the problem is when hedge funds are so destroyed, we can obviously start to see margin calls when their short positions go against them. That's pretty well known information. But just the sheer amount of short positions on the markets starting to go against hedge funds just to get back to neutral is going to continue to fuel this rally. And that's exactly what we're going to talk about here in this video. Go over the Ortex data to really wrap up this trading day because numbers are moving around a lot, guys. The situation is very, very fluid. And I want to give you guys my bull case and look at the technicals on AMC. Realistically, where are we going to go from here? And even the possibility of seeing a gamma squeeze over the next couple of weeks and the next couple of months. So let's get straight into this video. Hit that like button and subscribe to the channel if you have not already. If you have not already, what the hell are you waiting for, baby? It is right down there. Hopefully where my finger is pointing. If not, it's over here. I'm not sure exactly where it is, but go find it. Tap, tickle, touch, or smash the like button for me, baby, and that subscribe button while you're at it, because why not? It's free 99, and you guys might as well stay up to date with this information when a lot of people have given up on the ape community, when really, in all reality, let me just rant for a second. Where we currently sit is like pre-GME. Nobody gave a rat's ass about GameStop before it squeezed. Only a select few people, Roaring Kitty, and the people that watched his videos at the time and on Reddit with him, those are the people that made the most amount of money. And this really is drawing a lot of similarities to me, right? You've seen a lot of people drop out of this community that used to be large names, much larger names than I am. And I think that really presents a big opportunity because the people have not left, but some of the influencers, some of the people have really left. And some people might call it frustrating, but I think it is to your gain and your benefit. So let's get straight into this video without any further ado, guys. Like I said, the NASDAQ was up over 7.5% today. The S&P was up over 5.5% on the day. And this rally is very much likely to continue, in my personal opinion, when you have hedge funds so weighted to their short positions that even to get to a neutral level, whereas let's say neutral, right? Let's make this super simple so everyone watching this video can understand. Neutral, let's call it neutral. If the stock market goes up 2% in a day, the S&P or the NASDAQ, you're going to go up roughly 2%. If it goes down 2%, you're roughly going to go down 2%. That's neutral, right? You're not weighted to the long side. You're not weighted to the short side. That's where a lot of hedge funds want to be, because on average, the stock market goes up 7 to 9% every single year, basically without falter. Some years are really good. Some years are pretty bad. On average, 7 to 9%, where 2022 has really not been that story. It's been pretty much straight down. The NASDAQ does not lose over 30% in a year too often. And a lot of that is caused by the actual short selling that we have been seeing on the markets. And, AMC is definitely a part of that short selling story. And I think that's where a lot of the opportunity presents itself now that AMC is really close to, if not under, its fundamental valuation. And like this clip we're about to play briefly from Adam Aaron, it's like 20 seconds long. The reason I am bullish on AMC, so bullish right now more than any time really ever, is because of what I just said, right? The lack of attention is obviously a bullish thing for people that are still here, because that attention's not going to go away forever. It's going to come back. You're going to get those cheap options. You're going to get those cheap shares in which you have been seeing over the last couple of weeks. But like Adam Aaron says, the rest of this year, this quarter, and next year, and the next year after that, 2024, they're going to be very bullish for AMC. Why is that? Because movies are heading back to theaters.
You mentioned point blank. You say you need more movies. You don't make the movies. But it does seem like the number of movies are down big. And frankly, I don't get it. Because you prove without a doubt in your conference call that it is better to release a movie to the theater than it is to go this direct-to-consumer. What is taking them so long to realize how rabid customers are for more movies?
That is one good question. What is taking them so long giving us more movies? Because, if you go back in time when people were afraid to go out of their homes, like we understood it then, but that's not where we are in America these days. That's not where we are across the globe. Life is returning to normal. And if you actually look at movies on a per title basis, they're doing very well. People are coming out to our theaters. We're going to prove that again this weekend with Black Panther: Wakanda Forever. But the number of releases that has come out of all the major Hollywood studios combined is down still about 20 to 30% below pre-pandemic norms. Now, what they tell us is that these are all the production delays that were caused during the height of COVID. It does take about 2 years to make a major motion picture. So we're hearing that all the studios, I don't want to say all, but most of the studios are scrambling to dramatically increase the count of theaters, theatrically released movies. We're expecting the movie count in 2023 to be significantly greater than in 2022, and again in 2024, more than in 2023.
Now, why I'm bringing this up to you guys right now about essentially the slate of movies that are very exciting heading to theaters right now, this very weekend, heading throughout the next couple of weeks, next couple of months, and next couple of years, that are very different from what we've seen throughout 2022. Yeah, we've had a couple blockbusters here and there, right? A couple movies. Yeah, I can't even call it really a couple movies. You had Spider-Man that did over $1 billion at the box office. That's really it. Top Gun Maverick did well also. But other than that, it's really been a dry year for movies. And why I am stressing this to you guys is because when a hedge fund evaluates their short position, they're not evaluating what happened during the last 3 months. They're evaluating what's likely to happen over the next 3 months, the next 6 months, the next 9 months, the next 1 to 3 quarters down the line. What's the potential bullish catalyst? What's the bearish catalyst? And from my perspective, if I was a hedge fund looking at my short position in AMC, I've obviously more than likely made a lot of money in the stock. And at this point, are things going to get better or worse for AMC? Fundamentally speaking, because let's be honest, everything in the end revolves back to fundamentals. I would look to myself and say, hey, AMC's got a real shot here of going profitable over the next 3 to 9 months. I think I've sucked all of the life I can out of my short position. It's probably time to cover and pass this baton off to someone else. Maybe I might go long at the same time. It looks like a pretty attractive valuation to go long, considering there could be another short squeeze, or from my perspective, will be another short squeeze in AMC stock. Now that is out the way, and hopefully you guys are catching my drift here. Things are looking a lot better now over the next 3 to 12 months, 3 to 9 months, whatever time frame you want to put on it into the future, than they did in the previous time frame. Let's play this short clip from the Satori Fund about hedge funds being down over 50% on the year. And let's be mindful here. that not all hedge funds, but a lot of hedge funds are down over 50%. Not all hedge funds have to report to us. Not all hedge funds we're going to look at, right? A lot of smaller hedge funds are down a lot more than some of the larger guys that own, let's say, market maker type strategies like a Citadel's probably doing a lot better than your, $5 to $20 billion hedge funds in that regard. Now, in the beginning of this clip, Dan Niles is basically talking about FTX and the situation essentially with their liquidity problems that they are facing. Now, once this clip is over, we're going to talk about the bond defaults coming out of Russia and China next year. And check this headline out before we play this video. It says, China and Russia to drive 10% default pain for junk-rated emerging market firms. And that is a direct quote from JP Morgan.
And let's face it, there's a lot of hedge funds that are down 50% plus for the year. And so, could you have a long-term capital management type of situation, which for your viewers who don't remember, this is back in 1998 when you had the whole Russian bond default situation, et cetera. And then you had to have the world's biggest banks come to the rescue to save the financial markets. And, obviously people probably remember Lehman Brothers. And so that's sort of sitting in the back of my mind. And by the way, that's still a tail risk between now and the end of the year. On the positive side for tail risks, though, when I saw that statement from China saying they don't condone the use of nuclear weapons or something along that line, I'm like, so their relationship with Russia does have limits. They're telling the Russians they don't want this to kind of continue, and Zelensky sounded better about a potential truce, let's call it. That's an upside tail risk. So for us, we're still playing this for a rally at least until sort of that December 13th next CPI print. And this could be a huge one because you got to remember the biggest bear market rallies happen towards the end of bear markets. Even if you go back to Volcker, you had one 11% rally in the S&P, one 12% rally in the S&P before it went to its ultimate lows. Right. And that was towards the end. So we're pretty bullish between now and at least December 13th. You got to play it day by day, but that's how we're looking at it.
Now, let's get straight into this article. And we're not going to spend a whole lot of time on this. We're going to read the first 3 paragraphs because I think it sums it all up. You can get into the nitty-gritty details if you want. But really, this is what you need to know. So, this came out on November 8th. It says China's property crisis and the West's sanctions on Russia will drive a respective 20 and 66% of these two countries' junk-rated companies into default next year, analysts at JP Morgan have estimated. Their woes will also mean emerging markets overall will see a more than 10% high-yield corporate default rate for next year, keeping it at more than triple that of the historic average. Quote, we expect another high default year in 2023 focused on specific segments, JP Morgan's analyst said in a research note on Tuesday that describes China and Russia as the, quote, trouble spots. With Western sanctions making it increasingly difficult for Russian companies to make dollar-denominated bond payments, quote, we project another $28 billion of Russian corporate defaults next year, or 66% of the remaining non-defaulted bond stock, the JP Morgan note added. China's battered property sector is forecasted to have another eye-watering 46% default rate next year. The figure is already 52% this year, with even state-backed builders now starting to topple. Quote, we still see the possibility of an elevated default risk for the sector in 2023, albeit less so than in 2021 and 2022, if the sector does not receive any direct government support, the note said. And why this is also important is because hedge funds, if you guys didn't know it, they can invest in whatever they want. Most hedge funds anyways can invest in real estate, in bonds, in stocks. They can short, they can buy futures, they can buy crypto, they can do whatever the hell they want to do with their clients' money. And a lot of them have turned to these emerging markets and have put their dollars to work in places like China specifically, not as much Russia, but really China. And I think that's a big problem when it comes down to hedge funds liquidity, because even if you look at something like FTX right now, everyone thought they were okay. They're buying stakes in Robinhood. They're bailing out other crypto exchanges. and yet they're going bankrupt themselves. So I think you're looking at a potential credit crisis over the next, call it 3 to 12 months. I think it's really already started. So I think, over the next couple of weeks here even, you're going to hear more about firms going under, businesses going under, hedge funds going over, and especially crypto hedge funds. And that's not so good if you have short positions in AMC. That would mean they would have to cover on those short positions at some point over the next couple of weeks and the next couple of months. Now, I know I did say we were going to talk about a gamma squeeze here in this video, the potential of that, and look at the technicals, guys, but this video has really been jam-packed with information, and I don't want to take away from that for people that don't have the time to watch a 25-minute long video. So that's going to have to come out in the next video, but we are going to look over the Ortex data here right now. And the last cost to borrow rate that we got for shares that were actually sold short was 55.5%. That is incredibly high. That is incredibly bullish for someone like me that is looking at the cost of borrow rates and saying, hey, would it make sense to short AMC at 55.5% cost borrow rates? Absolutely not. So it looks like you're probably going to see a lot less shorting activity and potentially a lot more buying activity over the next couple of weeks. You guys can see it right here. These numbers are not going to lie to you. There was only 20 shares available late day trading on Thursday at a 55.5% cost bar rate. Now, the cost bar average is sitting at about 115%. The cost bar max continuing to rally at 344.82%. And these are not fluke numbers, guys. This number has went from 41% on Wednesday to 315% on Thursday, and likely Friday morning, it's going to go up even more. Cost of borrow minimum even at a 15% rating as of right now. And that's the one I'm looking at the most because I do think that has a lot more room to continue to rally as well. And this all puts a lot of pressure on hedge funds. Now, if we look at the option activity for Thursday, you can see 9 orders totaling $277.34 thousand, positive order value of 74%. And just overall, by this Friday, the total amount of open interest is sitting at 63.28% calls, 36.72% puts. And as you can see from the Stocko Tracker data, you have 30,000 calls that are currently in the money, 75,000 calls that are out of the money. Yeah, that is a lot that are still out of the money, but it looks like potentially here Friday, today, you could still see a lot of calls run into the money as we start to break above key levels, and it could get very bullish in a very short amount of time. So that is going to be all for this video. Like I said, guys, I thought we were going to have time for it, but I don't want to make a 25-minute long video. Stay tuned for the technical outlook. Stay tuned for all of the other details that we did not have a chance to cover here in this video. That video will be coming out here very, very shortly, so stay tuned for that one. Hit that like button in the meantime and subscribe to the channel so you do not miss that video because, hey, if you miss these videos, you might be missing out on some money, and you do not want to miss out on some money here in 2022. With that being said, guys, if you guys want to come trade with me live in real time as well, link down below in the description of this video. Until the next time, guys, enjoy your day, night, whenever you're watching this video. I will see you in the